Right now, silver is not just moving, it's deciding. We are sitting at a structural crossroads where one or two price levels will likely determine whether this market continues pressing higher toward historic territory or whether it pauses, pulls back, and forces patience on everyone involved. And here's the key. This is not a moment for ego. It is a moment for discipline, because when a market approaches critical decision points, the traders who survive are not the ones who guess correctly. They are the ones who wait for confirmation. Hello and welcome back to What Changes. This is the place where we slow the noise down, decode the structure underneath price movement, and prepare for the probabilities ahead rather than chasing headlines. I'm May, and today we are diving deep into the silver market, which is currently showing one of the most compelling and delicate structural setups we have seen in months. If you have been following precious metals closely, you already know that volatility has expanded dramatically. Price has accelerated upward in a sequence that now appears complete on the surface. But the real question is not whether silver has moved, the question is whether it has finished moving for now. Let's begin with the larger picture, before narrowing into the most important levels. Silver recently completed a 5-part upward advance. That is important, because in many structured market movements, 5 upward pushes often represent a full directional sequence. When that sequence completes, the market frequently pauses, pulls back, or resets, before deciding its next major direction. Now here is where it becomes interesting. The ideal upside objective for this recent upward leg sits at $96.77. That is not a random number. It is derived from measuring the prior structural movement and projecting it forward proportionally. Markets often move in measured expansions. When they do, those expansions tend to cluster around very specific price levels. In this case, $96.77 is the mathematically aligned completion zone for this upward move. However, and this is critical, a market does not need to hit its ideal level to be considered complete. It only needs to satisfy the structural requirements. And right now, silver already displays 5 clear upward segments. That means the move could already be mature, even if price never touches $96.77. This is where patience becomes power. As of this recording, silver is holding above $90.65. That level has quietly become the hinge of the entire short-term structure. As long as price remains cleanly above $90.65, the probability of continuation toward $96.77 remains intact. But if price breaks decisively below $90.65, the tone changes immediately. Underneath that hinge level, we have additional layers of support that matter. The first major structural floor sits at $89.60. That level represents the low of a previous internal pullback during the upward sequence. If silver falls below $89.60, that is not yet total structural failure, but it is a serious warning that upward momentum is weakening. Below that, we have $88.28. That level is the deepest internal low within the recent advance. If silver falls below $88.28, the 5-wave structure is officially invalidated. At that point, the probability shifts from continued upside toward a larger corrective phase. There is also an intermediate danger zone at $85.55. A heavy aggressive break below $85.55 would signal that sellers have regained control with force. That would likely trigger a deeper retracement phase. Now let's talk about psychology, because numbers alone are never enough. When a market approaches a widely anticipated target, like $96.77, something subtle happens. Confirmation bias begins to take control. Traders who are long begin to search for reasons that price must continue higher. Traders who missed the move begin to chase entries out of fear of missing out. Short sellers begin to feel squeezed and emotional. This emotional compression is often strongest right before a decision. Discipline in this environment means separating what you want from what the market is actually showing. The market does not care about our opinions. It responds only to supply, demand, positioning, and liquidity. If silver pushes cleanly through $96.77 and holds above it, the next extended upside zone sits at $99.35. That level represents a psychological magnet. Approaching $100 per ounce would create intense media attention, retail excitement, and likely volatility expansion, But probability must always come before prediction. Right now, we do not assume silver will reach $99.35. We simply acknowledge that if $96.77 breaks with strength and holds, then $99.35 becomes the next measurable ceiling. Now let's shift into structural flow. The recent upward movement shows signs of exhaustion characteristics. That does not mean it must reverse immediately. It means the velocity of buying has likely reached a late stage. In late stage moves, price can still rise, but risk to reward begins to compress. This is where many retail traders struggle. When price has already moved aggressively higher, it feels emotionally safer to buy. But structurally, that is often where risk increases. The best entries usually occur when the market feels uncomfortable, not euphoric. This is why waiting for pullbacks into defined floors such as $90.65 or even $89.60 can offer more balanced positioning than chasing strength into resistance near $96.77. Now let me share how I personally think about positioning in this environment. For long-term holdings, I maintain exposure to physical silver and selected mining equities because my thesis extends beyond short-term volatility. Long-term exposure is based on macro monetary expansion, global debt accumulation, and inflation dynamics. That position is not adjusted frequently. However, on the short-term side, I treat this current structure differently. If price holds above $90.65 and shows continued strength toward $96.77, short-term upside trades remain valid. But if we see a break below $89.60, I would consider hedging that short-term exposure, either by reducing leverage or adding temporary downside protection. That is not fear, that is probability management. Long-term investing and short-term trading require different emotional frameworks. Long-term exposure tolerates volatility because it is based on multi-year conviction. Short-term trading demands agility because it is based on structural shifts. Now let's talk about ceilings and floors in simple terms. A ceiling is a price area where upward movement repeatedly stalls. A floor is a price area where downward movement repeatedly stabilizes. When a ceiling breaks and price holds above it, that old ceiling often becomes a new floor. When a floor breaks and price fails to reclaim it, that old floor becomes a new ceiling. Right now, $90.65 is functioning as a floor, $96.77 is functioning as a ceiling. Between those two levels, silver is compressing tension. Breakout above $96.77 opens the path toward $99.35. Breakdown below $90.65 opens the path toward $89.60 and potentially $88.28. Notice how this framework eliminates guessing. We are not predicting direction, we are mapping reactions. Markets reward reaction, they punish anticipation. One of the most dangerous behaviors in trading is emotional attachment to a scenario. When traders identify strongly as bulls or bears, they subconsciously filter information to support their identity. That is confirmation bias. It feels intelligent, but it is often destructive. Discipline means saying, if this level holds, I lean one way. If this level breaks, I lean another way. It means allowing the market to prove itself. Silver right now is asking a question. The answer will come through price behavior at $90.65 and $96.77. If buyers defend $90.65 and push price cleanly above $96.77, momentum likely expands into the upper $99 zone. If sellers break $90.65 and especially $89.60, a deeper reset becomes probable. We do not need to know which will happen. We need to know how we will respond. As we move into the upcoming trading sessions, volume and speed will matter. Strong moves accompanied by expanding participation tend to follow through. Weak pushes that quickly reverse tend to signal exhaustion. Remain calm, remain neutral, let the structure confirm. Remember, wealth is built through disciplined repetition, not dramatic predictions. The goal is not to be right once. The goal is to manage risk consistently over time. Silver is volatile. Precious metals amplify emotion, but structure always leaves footprints. And right now, those footprints are clear. Above $90.65, continuation remains probable. Below $89.60, caution increases. Below $88.28, the structure resets. Above $96.77, upside expands toward $99.35. Those are the numbers that matter. Trade probabilities. Protect capital. Remove ego. Because in markets, patience compounds faster than excitement ever will. Thank you for being here. Stay disciplined, stay objective, and I will see you in the next update.